And so, ladies and gentlemen, we have it's 1:02 p.m. Central Standard Time. We're going to give it maybe about another 2 minutes or so to let some more attendees keep piling into the room. But we definitely want to thank everybody for making time for us today on Saturday for the second installment of our Financial Foundation series. Last time we were with covering real estate and mortgages with Kenneth Baker, and who's a realtor, and with Miss Tina, who does credit restoration, and Chris Perry, who is a inspector. So we went through the real estate process, acquiring mortgages, first-time home buyers, kind of what to look for, what banks are looking for from a credit standpoint, the best way to facilitate that realtor purchaser relationship. And today we're going to be looking at taxes and what role that kind of plays in your financial outlook. And so, and aligns to investing and what role that plays, and how super critical it is to make sure that from a tax standpoint, you are on point. So I'm joined by my good brother, Michael Pridgeon of Eminent Financial Services. So I got about 104, rolling to 105. So we're gonna go ahead and get kicked off. My name is Al Moore. I'm the Vice President of Investment Solutions at Regions Bank. I've been doing finance, and I've been a financial advisor for a few years. And excuse me if I have to let people in. I'm sorry about that, y'all. I've been working in finance for about 10 years. I've worked at some pretty big companies in the industry before kind of settling where I am now, doing financial planning, investment planning, and wealth management. And I'm joined by my good brother, my fat brother, Michael Pridgeon, who's a CPA and the CEO and president of Eminent Financial Services. So I want to thank you, Mike, for taking time out your Saturday away from business and away from your clients to do this with me, man. You doing all right today?
I'm doing good. How about yourself?
I can't complain. I cannot complain, man. We finally got thawed out up here after Snowmageddon. So
after you said there wasn't going to be anything on Thursday morning.
I didn't. I honestly really didn't think we were going to have any inclement weather. But I also, I woke up and I went down, I looked out the window, I was like, I didn't see nothing. I was like, oh man, we good, ain't no snow. And then my wife was like, you should put your contacts in. And as soon as I put my contacts in, I was like, oh man, it started snowing. And up until that point, I don't care what nobody say, it wasn't any snow. But so yeah, my wife and these lying eyes of mine, man, they brought some snow down, and it cancels, had us in the house for about a week. But yeah, I'm glad to be outside of that, man. So luckily, got to go back to the office and had a bunch of missed calls and stuff. But busy work is always good work, man. Especially in our field. Like if you're not busy, that's not good. So we definitely like to stay busy, man. So just before we kind of hop into our agenda, man, I just wanted to give you a second to kind of give people some background on your company, man, and how you got started, and just a little bit about yourself.
All right. Well, as you said before, I'm Michael Pridgeon, CPA. I'm from Pine Bluff, Arkansas. Graduated high school in 2000, finished my accounting degree at ULR and Master's of Business at Webster in 2011. I started my business in 2008 with the birth of my son because at the time I was working a job, and just like with anybody, with new children coming into the world, you want to already set plans for them because you want them to have better than what you had growing up. So for me, it's always been the ambition to become an entrepreneur, but until then, I didn't know which way I wanted to go. But I came up with Eminent Financial Services, and I said, let me start doing taxes because, this is how I'm gonna get my foot in the game. And that's where it started out. I just started doing taxes for family members, friends, fraternity brothers, and sorority sisters. and then kept on working my main job, which didn't provide any growth because they were not allowing me to advance. And then when President Obama got elected, it was just this overwhelming desire to be empowered as an African American man, just to have something of my own. And then I seen the need to where I started reading some books and where it just talked about paradigm shifting. And you look at your environment and where you came from, and you like, well, no wonder we can't get out of certain situations because this is all we see growing up. And if we don't know any better, we won't do any better. So that's where Eminent Financial Services came from. It's just the desire to really empower yourself and really just, treat yourself in a state of royalty in a higher level to where you don't have to worry about where you came from. You can always look to where you want to go. So that's why now I just focus on small businesses and lower income, undeserved communities because, well, I wouldn't say undeserved. I would say, and I get confused on this word.
Underrepresented or
There you go, underrepresented. Yeah. So because the people that don't look like us don't market to us.
right.
And so they tend to overlook because they don't think that we have a desire to have wealth for our families. So therefore, that you always see the only thing that you see in communities of predominantly African Americans and Latino Americans, if I want to say that, or just impoverished people, period. You only see tax preparation offices and insurance, but not once do you not hardly ever do you really see a group of banks around that area, or you see financial advising offices because right. they don't think that that's important to our families because we do, quote unquote, they look at us as consumers, not investors. So again, with the concept of Eminent Financial Services, the sum of all your financial needs, my goal in my firm is to create a platform to where all things, mostly all things financial, especially dealing around the subject of accounting, has a home in one place. Whether it's from investing, credit building, IRS representation, accounting, and business consulting.
Okay, cool, man. I appreciate you sharing that with me, as well as I do the participants as well. And I totally agree with everything that you said, man, in terms of proper representation and just making sure we get the education out there about how important financial stability is and how important it is to be thorough financially. I think historically, it's not that we've necessarily had a problem accruing finances or income, but being thorough in terms of what all that means, how it works, proper planning to create a system to where our finances and our income goes from something that we have to work for to something that works for us. So, and with that, that's kind of what we want to turn into today. Being it that it's tax season for most people, that can mean a lot of different things for a lot of different people. For small business owners, it normally means that they're about to have to pay something in. W-2 employees, they're normally planning to maybe get something back, but kind of with the new trend, there's been more individual, or what we call retail investors, as people on their own, taking their own income and investing into the market, which is a good thing. But it's also a lot of moving parts to that. So we just kind of wanted to touch on some things that will be helpful in your individual endeavor, or if you're a small business endeavor, just some things that may not have been on your mind, or you just kind of wanted to get a little bit of information about. That's what we're going to go into today. And so, and firstly, I just kind of wanted to talk to some of the people who are some of my investing audience, who, whether you had a good or bad year last year, a lot of people are under the impression that last year, because of COVID, was a bad year, but actually, like, the S&P was up either 16 or 18 points. So a lot of people who didn't panic and make erroneous choices with their finances, like actually stood to make a lot of gains last year. And just depending on how long you've held those assets, wherever you hold your funds at, your securities, they're going to be sending you a sheet to file with your taxes. So if you did really well last year, you're probably going to be paying something called a capital gains tax on your securities. That's just like if you bought a house within a year and upgraded it and flipped it, you have to pay a capital gain. Whenever you sell a big asset, you're going to have, capital gains tax. That's something I go through with my clients a lot. And one of the main themes that I have within my practice in terms of income or money or assets is not necessarily what you make, it's what you can keep. Just depending on how you have your business set up, how you have what you're invested in, the amount of time that you've been invested in. I've seen a lot of people who I might have two different clients. One might make 100,000 in a year. One might make 160, but the one who made 100, because of how he was set up tax-wise and how his assets were allocated, he got to keep and take home more of his money than the person who out-earned him because he had a more savvy tax situation. So it's just things to consider. I know we're in the age of a lot of cryptocurrency and things like that, and people constantly ask me about what I think about crypto. I think that there's money to be made in crypto, but I forgot our disclaimer. This presentation is for informational purposes only, and it does not constitute a binding contract with either myself or with Michael Pridgeon. So always consult a financial professional in your area. Again, these are just for informational purposes only. So now that we got the church house cleaning out of the way for legal purposes, and I had to do that because my homeboy Lee is an attorney. He always tells me to keep my disclaimers on there. But in regards to cryptocurrency, people say, "Oh, it's going to be the new currency of the future," with this, what have you. Regardless how you feel about that, whether that's true or not, something that I always gauge on, and it's just me personally, I'll say, can you pay your taxes with it? So what people don't understand, if you bought crypto at 10,000 last year, I'm just using hypothetical numbers, and you sold it at 50,000, you're gonna have to pay capital gains tax on that in cash. You can't go to Uncle Sam and give him a Bitcoin to pay your taxes. So that's something that I'm always mindful of in terms of what currency is powerful. Like if I got a letter from the IRS and they told me I could send them a half of a Bitcoin to pay my taxes, I would be all in. But they want their fiat currency, they want cash. So, and the thing about capital gains taxes, there's two types. There's short-term capital gains tax, and there's long-term capital gains tax. So short-term capital gains tax normally fall in line to wherever your income tax bracket is. So if that's anything that you've held for less than a year, it's taxed normally what your tax bracket is. Long-term capital gains tax can range from, that's something held more than a year. Those can range, it's either fixed at 0, 10, I think the highest it can be taxed is 20. But short-term capital gains tax held less than a year can be taxed much, much higher. And so that's something to consider. And a lot of times I tell people who they're working, they have a 401k, their job, and they're like, yeah, no. I'm like, let's look into maybe opening up a Roth IRA, or especially if you're a high income earner, just depending on where you are, that can fluctuate. Like a high income earner in Arkansas might be 60,000, where a high income earner in California is probably, much, much higher than that. So, but according to where you are, anybody making over 50 or 60,000 a year, I would say anywhere, should have their own individual IRA, because that's extra money that you can contribute to, that you can reduce your tax burden. The government incentivizes people to kind of take care of themselves. So whenever they offer you opportunities to put away for your retirement, they let you do the gains grow tax deferred. And they also say, well, we'll cap it at 6,000. But if you put 6,000 in there, when you file your taxes, you can write that amount down, specifically for small business owners too. I do a lot of what's called SEP, self-employed pension plans, or SEP IRAs for people who might not have access to a 401k or 403b, but want to start putting something aside for their retirement, or they might have 1 or 2 employees. And so not only can they deduct what they put away from themselves, if they match or contribute something to their employees, they can write that off as a business expense as well. So it's just creative ways about knowing the avenues that you have, being creative and using those to, like I said, it's not necessarily what you make, it's what you can keep. And sometimes like tax deferred can be a big thing, because compounding interest growing over a long amount of time, even a moderate amount from like 5 to 8%, it seems small, but tax deferred over a length of 5 to 10 years can be a dramatic swing in what you have. So that's just a few of my things in terms of just kind of some basic stuff for people, like investment wise. Just be aware of what you're investing in, be aware of when you're buying and selling. Like sometimes it's better to hold something a little longer to reduce that tax rate. Do you want to look at things from a short term or from a long term standpoint, and what that means? Make sure that you're talking with your advisor and your CPA about the trades that we're making, or the securities that we're buying. Are we buying bonds in the place where we live? Because if you buy a municipal bond from where you live, bonds are not only not taxed from a federal standpoint, but if you live in the place where you buy the bond, it can be free from tax on a local and a state level. So you can bypass taxes those 3 ways, which means that a lot of times you can out earn investment paying a higher interest rate, because when it sells, you don't have to pay certain taxes on it. So those are all things to kind of be aware of from an investment standpoint. Like I said, you ought to keep tabs on anywhere that you can decrease that tax burden. Always pay your fair share, but you don't want to pay more than that if you don't have to. So that's kind of my little spiel from the investment piece. I want to kind of transition to Mike to kind of talk through some things in terms of more thorough on the tax side. So I just kind of start with this, Mike, just in terms of when people say, "Oh, I'm in this tax bracket," or "I'm in this tax bracket." Can you kind of give us a high overview of what a tax bracket is and what that means? Because some people think, like, if I made 100,000, I'm in the 30% tax bracket and I have to pay 30% on 100,000. So can you just kind of break down tax brackets and how that works?
All right. Well, that's a good segue into what you was talking about. And basically, tax brackets is based on your net taxable income. So you can earn $1 million and still be taxed at a 10% tax bracket. So it's a matter of your strategies, your investments, what you gain, what you lose, and how all those things are taxed according to tax code. I know, and me and Al was briefly talking before this podcast started, and we was talking about just tax brackets and tax implications. And one thing that comes to mind is that when Mitt Romney was running for office, they were talking about his taxes and how he only paid 10% taxes. Well, most of that was due because of the Bush tax cuts for business owners that included 10% tax rate on dividends. And so with you being an owner of certain corporations and they pay you in dividends, then you don't have to pay tax on ordinary income. But then again, you have the alternative minimum tax, or AMT, which would allow you to pay a minimum amount of tax, but still, if you're at the ordinary rate of someone else and you don't have any ordinary income but only dividends, then you're only going to be paying 10%. So tax brackets, in the way the law has changed since 2017, is basically where you're paying gradually a lower amount of tax as an individual, but as you get more into the mid range, which is between the 22s and the 28% tax rates, where you are taxed more on your income there. People that make over, say, over 500,000, it pays about 35% tax rate. They usually have other investments that can keep their taxes lower. So tax bracket wise, as Al was talking about, you want to set up your investments to where you can kind of have some more tax deferred deductions in terms of income through 401ks, through 403bs, and any other type of tax deferred retirement vehicles.
Okay. And thinking about that, I know that you work a lot with small businesses, and people have some small businesses have been awarded with the PPP loans.
Mm-hmm.
For people who aren't really sure what that means or what effect they have on the business owner's tax, if any, how has the PPP and some of the COVID relief, how is that affecting this tax season?
All right. Well, last year when they first released it, they released it with little guidance on how it would impact you tax-wise, because the SBA put a criteria out there and banks followed it. And so individuals or business owners that filed their taxes using Schedule Cs that normally claim losses at during the year restructured their tax returns to show positive income. So with that being said, if they didn't prepare themselves to pay estimated quarterly taxes during the year, that created a tax burden for them in order to get a PPP loan. Now, with just recently, as of a couple of weeks ago, with Biden talking about changing the PPP criteria, the PPP criteria has changed to where business owners with no employees or employees under 20 would use the gross number rather than the net. So if you're using the gross number and you still have a loss for your business, then you're eligible for the PPP as opposed to having a loss and not being eligible. So now with the new criteria that's only going to be available for 2 weeks starting March 9th, you go out there, you can apply for the PPP, but you don't have to worry about the taxes that come with it because you're not required to show profit to get it.
Oh, okay. That I didn't know.
Yeah.
So it's the new, I guess the new area where you can apply starts March 9th and it goes for 2 weeks.
Mm-hmm.
Okay. So, and just kind of sticking with that in terms of small business owners and just employee, non-business owners who may do like some 1099 work on the side, or they make money outside of just their regular employment. What, as a CPA, what are some of the things that you've seen for people who have done their taxes by themselves versus when they come to you, or the CPAs, and some of the common mistakes they make that CPAs can help them with?
Well, the most common mistake when it comes to independent contractors, sole proprietors, or people that own the LLCs by themselves is that they try to maximize their deductions to avoid taxes. And in some ways, I agree with that mostly, but when it comes to involving other institutions like banks and things that you want to get for your business as well as for yourself, you have to show some profit. So when people come to me, they're usually like, hey, I need help being able to get this loan so I can get a house. And it's like, okay, well, what was your tax return the year prior? I get the tax return and it's a $20,000 loss. The biggest loss that I've seen, I share this with you, the biggest loss that I've seen somebody take at one time was $100,000.
Right.
And they had maybe about 60,000 in gross income, but they took $100,000 loss. And looking at that, I'm like, internally, like thinking, wow, Like, why would you do that to yourself? Because that creates a net operating loss, which, you carry forward 20 years on the individual side. But from a banking standpoint, it just shows that you haven't made any money, and banks can't support that, can't support a loan if you don't show any profits, the ability to pay the loan. And so from there, it's the other thing is that showing that profit, incurs tax liability. Then most people don't realize that they are responsible for paying a quarterly estimated tax. Like if you owe over $1,000, the federal government tells you that you are required to pay an estimated quarterly tax unless you follow the safe harbor rules. The safe harbor rules, and I may get this wrong, but you can always look this up. It's 90% of your current tax due, and 100% or 110% of last year's tax amount. So you would have to pay that in if you are expecting like a big increase in your tax liability. So an example would be if I owe $5,000 for tax in 2019, then for my 2020, according to the safe harbor rules, no matter how much more my income is above that level, I had to pay at least 5,000. If the 5,000 exceeds a certain amount, then I have to pay 90% of whatever I'm going to owe currently. Because if you don't pay estimated quarterly tax, or if you don't pay enough tax in throughout the year, the IRS will hit you with an underpayment penalty.
Okay.
And
wow. And just speaking to that, before I was on the investment side, when I just worked on the retail side of banking, like I saw that a ton from small business owners or self-employed people, in terms of like they would come to the bank to apply for a business credit card or a business loan, and they had done their taxes, but as you said, like they reported like so many losses, and I'm thinking to myself, like but I get it from a standpoint of like that's I think conventional wisdom, and that like nobody wants to pay tax. We do as an obligation as a citizen, but you kind of have to think, like my advice to all business owners is like start paying your taxes before you think that you have to, because like I said, when you come into the bank to get a line of credit or to get a business credit card, most banks, I mean, there's probably some small community lenders that take more risk, but the average bank is going to ask you probably for your current profit and loss statement and your last 2 years of tax returns. And if you don't show profitability, then like there's no credit or score that can bypass the simple fact that like what like banks are using to gauge how likely it is for you to pay this money back. So if you show me the last 10 years you've been losing money, why would I loan you some money that you just basically expressed to me that you can't pay back? But like I said, and then I've seen some people come back a year or two later and kind of got it together. And like I said, it's more so common with like smaller self-employed people, like people who work in like the cosmetology field or like agricultural landscape or something like that, because there are so many costs, and their income does kind of fluctuate so much to where they want to reduce their tax burden. But I would always say you want to make sure you have a solid 2 years of showing profitability if you want to have institutions fund you. Now, if not, then to each their own. But you definitely want to have at least 2 years of some kind of profit, so that you can expand your business or scale by using OPM, other people's money. So yeah, I am glad you touched on that. Another thing, I'm going to my list here. I was going to try and get your opinion on. So in my field, and you and I, we have some mutual clients, businesses and things like that. But for people who have, are starting to generate a good amount of assets and income, and they might be looking at retirement in the next 10 to 15 years or something like that. what is your best way? We kind of touched on it earlier in terms of passing assets. What do you think is the best way to do that? Like if you have somebody who's got a parent that might be older and they're trying to do some estate planning together, what's the best way to pass assets?
Well, as I, told you earlier, in my belief, and, to each his own, whatever you decide to do, whatever research you, decide to take, or whatever financial advisor provides you the information. In my opinion, life insurance is the best vehicle to transfer assets, at least from a standpoint of money wise. So with anything that you do, I encourage everybody to get a life insurance policy, whether it's a term life or a whole life policy, or whatever policy that they come up with, universal whole life or conversion, whatever. There's so many out there that you can use, but at the end of the day, life insurance is a non-taxable vehicle that creates wealth for many generations, and it has been for so many years. And the point with life insurance is that you don't want to get life insurance to the at the value just enough to bury somebody. You want to be able to get life insurance at a sufficient amount to where it would take care of your family for at least the next 20 years.
Okay.
And so with that, you receive a life insurance amount once the decedent passes and the beneficiary takes over the money that's left. If you could put that into an investment, just a simple investment where it can just earn a small percentage rate over an annual period, and that can pay you an amount that could be an annual salary that you can have that you don't even have to work for. So, and only then those earnings would be taxed, but the corpus of it, and by corpus I mean the death benefit. The death benefit of it is not taxable, so you don't have to worry about, if you take out that part of the income, is it going to be taxable to you? So you have the ability to create so much wealth with life insurance, as opposed to just other things like 401ks and annuities, Roths, and all of that. Although those things are good, and I'm gonna get to answering the question that Al actually asked. Those things are good, and they provide benefits as far as creating wealth. But again, with the non-taxability of life insurance, to me, that's the best thing to go. Now, in terms of transferring assets from your parents down to the children, or to another entity, I would say do it through a trust. And doing it through a trust at the earlier part of your life, if you don't expect anything significant to happen to you, you should probably do a revocable trust, because revocable trust, and Al is more knowledgeable in this area because this is his lane. You have the ability to do more changes towards the beneficiary, where things may happen to where your kid may have kids, and then those kids may have kids. So it allows changes within that trust to accommodate those new members that need to be a part of the trust, that can receive benefits from that trust fund. Also, you can look at irrevocable trust, which doesn't allow any changes, but you want to do that towards a later age, when you are trying to do away with assets being in your name as you get older. So other ways you can do that is through estate planning and through gifts. So IRS provides gift tax, which allows gifting exclusions for certain individuals. Especially, there's an unlimited exclusion for spouses. There's a $14,000 exclusion for children, and then certain things for medical payments and college tuition payments as well. So you can do away with some of the things of your estate through the gift tax. That's something that I don't have a whole lot of experience, because my clients have not reached that area, But if your estate is, say, not more than $11 million, then gift tax typically is not going to affect you much. But you do have the right to use that for certain exclusions if you are trying to transfer your assets away from your name as you get older.
Okay. Okay. Yeah, and just to kind of piggyback on your your thoughts on trust, I do agree with that. Trust kind of always allow for a lot more structure, and again, that's something that your advisor, I work with attorneys, and the creation of the trust. But it's a good vehicle because once you get to a certain point of financial stability, you kind of focus your attention on you want to control everything, but personally own very, very little so that you can create a sort of barrier between yourself and your assets. So trust can really help with that. And or, if it's certain people that that you don't like the tune of their jazz, you can make sure that, I've had more than one client come to me and say, "Hey Al, I got a question. What happens to me if I pass and I leave my son, $1 million and him and his wife gets divorced?" And of course, the general answer is, we have to talk with an attorney to get a sure answer to that. But in places where assets are considered marital property, because the lady's concern was, if my son divorces my daughter-in-law, like, does she get to take some of my estate with her? And in some cases, like, that can be the case. So people want to protect against things like that, to say, okay, well, I want to set my trust up to where, I have exclusive rules or guidelines to how much is distributed to who and to when, just to make sure, and that it provides certain language that should X, Y, and Z happen, this is how we compensate for that. So trust can be used in a myriad of ways, to definitely help protect yourself. And like I said, a lot of times, because of some of the costs associated with maintaining the trust, they don't always make sense. There's simpler ways to do it, but the principle of having an instrument to kind of follow, is a good thing to have, especially if you have like older parents or something. You want to look at things like, I forget the term for the medical thing, but like medical POAs or POS for your parents if they become incoherent and can't make their own choices. It's things that we never really think about, but they can have um, a substantial effect on our parents' income or on family income. So those are things you definitely want to think about. Another thing I was going to ask you, because I know you handle all my taxes, so I don't even think about it. But some people have asked, what is it better to itemize my taxes, or should I just file, generally without itemization? Can you just kind of speak to kind of what itemization means, to file your taxes itemized, and the alternative, and which is better, or not necessarily which is better, but how they work?
Well, just answering the question from a basic perspective, it's always better to itemize if you can. Uh, Itemization follows your medical deductions, your state taxes deductions, which includes your withholdings, your sales tax, your real estate and or property tax. So any state taxes that you pay, they're eligible to be deducted federally. Your mortgage interest, your qualified mortgage insurance premium, and also your points on your mortgage also work into itemized deductions. Your charitable contributions, whether it's cash contributions to church or non-cash contributions to Goodwill, those things can also be worked into itemized deductions. Itemized deductions is not quote unquote business expenses. Business deductions will be part of your business deductions from whatever business tax return or schedule that you use, whether it's a Schedule C, 1120, or a 1065, or even a Schedule K that you would use to for those deductions. But yes, itemized deductions are typically personal deductions. Now, one thing that itemized deductions are not allowed anymore, you're not allowed for unreimbursed work expenses. So a lot of questions that I've been getting as of late is if someone's is working a full-time job and they do something for the company, like drive around for certain things or whatever, but the employer never repays them. In the past, that will fall up under the 2% miscellaneous deductions, but with the Tax Cut and Jobs Act, that went away in 18, and so there's no more 2% miscellaneous deductions. That also includes like if your house went up in a fire, and well, that's another thing. If your house went up in a fire and you lost a lot of jewelry or a lot of personal assets, which will cause casualty losses. Casualty losses are not allowed anymore on a federal side, but they are allowed on the state side. So the state hasn't done away with casualty losses, so you're able to deduct it that way if you itemize through the state. In most cases, the standard deduction is typically higher than state deduction. Like just for Arkansas, a standard deduction for federal is around 12,400. It might not be the exact number, but it's 12,000 plus. For the state of Arkansas, and it's been this for several years now, the standard deduction is 2,200. So with everything that I just mentioned, if you have those deductions available, you would best serve yourself as far as taxable income to itemize rather than just using the standard deduction.
Okay. So, just kind of thinking through what you said. So if you drive for work and you had in the past deducted your miles or deducted your gas as a part of your work, you're saying that those deductions are no longer available.
Correct. So they're not available, and even if your employer doesn't reimburse you, you can't get any deduction for that.
Oh, okay. So are there, with this upcoming tax year, are there any new deductions that have been added?
No, there hasn't been anything new. The only thing that changes with the tax law currently right now is the income brackets a little bit due to inflation. So any tax code always has a few $100 adjustment for inflation. But the tax code is not due to change until the end of 2024, because that's when in 2025, that's when the tax cut act is no longer valid. So you will see probably after 2023, they're going to be talking a lot about taxes and maintaining certain tax cuts, doing away with certain tax cuts, maybe taxing more on the wealthy as opposed to giving more benefits to the wealthy. You're going to see that a lot in the next coming 2 to 3 years. And usually it depends on who's leading in the House or the Senate that's going to really flow to. So like the year when Trump was elected in 2016, you had both Senate control and House control through the Republican side of the government. And so with that, they were more concerned with getting tax cuts passed to the wealthy, because that's where most of their side usually flowed on, as far as the wealthy, as opposed to Democrats. And Democrats focus on, and I know I've been talking about politics, but I mean, you got to think politics does affect a lot of the tax cuts, because everything goes through the judicial system, and not judicial, but the legislative. So with that, we're going to focus more on the middle class. So there may be a higher tax amount that we'll begin to pay in a few years, as opposed to right now. but the benefit that we can receive right now through taxes is through self-employment. And so if you are even if, and so what I want to do with anybody that's listening and may go back and listen later is encourage you to start some form of business, whether it's um, a sole proprietorship or a single member LLC. If you can, just start a sole proprietorship, because you don't have to go through any state to register that, and you can use your social security number, but at least you can have a business. And the reason why I say this is because this is a way to lower your tax liability if you have deductions that you can push through your business from your home. And so, but even with that, you got to earn some money. You can't just open a business and not make any gross income. You have to earn some money at some point. But with what we talked about briefly through IRAs, retirement contributions and all that, these having a business is a good way to increase your deductions, therefore lower your tax liability.
Perfect. Yeah, I was gonna ask you about that. Just kind of elaborate on how important it is for individuals to, from a tax standpoint, like how vital having either a sole proprietorship or some kind of small business is, especially if you're a higher earner, man, because taxes can really eat you up on that front. So
Yeah.
I am glad you touched on that.
So like, the example, what you were saying about the self-employment and solo 401k. So as a business owner, you have the ability to put away $57,000 that you can deduct from your business as a contribution towards your retirement. So as a worker working under a company, earning getting a W-2 every year, you have the ability to maximize your contributions to $18,000. But you can take another 38,000. I don't know exactly what amount it is this year. I think it was the last time it was like 58,000. But you have another 41,000 that you can take, and you can put that towards your company and put that in your retirement. That won't cause you to pay any tax when you put in the contributions. So if you want to if you are a higher earner and you want to maximize your ability to retire early, this is something that can truly help you, as opposed to just doing it through your company and not receiving any more additional benefit after you contribute the max of 18,000.
Definitely. I definitely 100% agree with that. And I don't think that's something that a lot of people are aware of, being able to structure it like that for their own benefit. Because like throughout the year, I think people just kind of see, well, I'm contributing to something, like you just see it as money that you're losing. But on the back end, it's like when you do your taxes or when you look at the growth overall, you will see how making those changes intermittently throughout the year is definitely been beneficial in the long run. And that's what the financial foundation series is about, is looking over a long-term perspective of like actual having a sound financial platform, and not just what few dinks and dunks can I make to kind of make some money or get rich overnight. It's more like putting together a plan and a steady foundation to build upon, so that you can just gain more control.
Yeah. So taxes is always has been about the long game, not about the short game. Because if you look at the way they give more tax breaks towards retirement, it's like they're encouraging you to put together retirement so that you wouldn't have to be paid out in Social Security. So with that being said, it's like if you are 50 years old, they'll increase the amount that you can contribute towards your retirement, because they don't want you to use the Social Security, because if everybody relied on Social Security, the Social Security fund is going to eventually get depleted. Because if people are not paying as much in taxes, especially when in the latter part of our life, well, if we're talking from 80s all the way up until right now in 2021, the wealthiest don't pay Social Security after they earn a matter of 130,000. So they
Wow.
maxed out their Social Security, and then they only paying about 1.45% in Medicare. So if you're $1 million earner and you earn, that 134,000 in 1 month, you paid your Social Security for the year.
Wow.
So
Wow.
so with that is always the encouragement to self-fund your retirement rather than waiting on the government to do that, because with everything that they give you, it's always tax breaks towards retirement. For instance, like it's always been that you can start your own IRA account and you can contribute a max of 5,500. That 5,500 will be considered a taxable income deduction or adjustment to income on your AGI. So if you had 85,000 made in a year and you started your own individual retirement account and you contribute the max of 5,500, then now you knocked off about 5,500 of your retirement. If you're filing jointly, you and your wife can contribute $11,000 together. That knocks off 11,000 off your retirement. In addition to that, if you're 50 years old, they added a couple $1,000s onto that. But get this, you have until the time that your taxes are due to make your retirement contribution. So we start the year off in 2021 in January. Then April 15th of 2022, you got all the time to make a retirement contribution of a max 5,500 to be deducted on your 2021 taxes. And so this year, the retirement contribution deadline date is June 15th. So they're giving you an extra 2 months to make your retirement contribution so that you can reduce some of your income and therefore fund your retirement.
Yeah, and that's huge. That's what I've been doing a lot for the past couple of weeks. I've been doing a lot of 2020 contributions for taxes, because the people with means, they understand how big that is to fund your retirement and pull down your income for that year. So let's just kind of wrapping up. I know last year was kind of turbulent with people. A lot of people had work transitions, or were without work, or were displaced from their job. Is there any information or anything people should know about how unemployment might affect their tax obligations for this year? Is it just is it just looked at as income, or is it taxed differently, or how will those unemployment and COVID relief funds, how will those affect people's tax situation?
Well, I'm glad you asked, and this was something that I was thinking about talking, because I know it wasn't originally part of our notes, but I'm glad you made it, because I was going to talk about that. So in terms of unemployment typically for some states is not considered taxable income. But for federal wise, it is taxable income. But as of recent, with certain states changing their rules, unemployment proceeds that you receive is considered taxable income. It's not earned income, so you can't get any earned income credit from it, but it does provide you with having to pay tax on the amount that you receive from the unemployment office. So I know I've seen a couple tax returns with people receiving the PUA and everything, and they take out some tax for federal, but the state system still acts as if this income is non-taxable to the state. So with that, if the system for the states that haven't changed their systems around to where it affects the current law, then it's going to hurt people on their state income taxes. So, example, Al, if you drew unemployment for about 8 months throughout the year, and you receive $14,000, that $14,000 you know is going to be taxed federal. But if you're not aware of the rules on your state side, and then they never give you the option to take out taxes from your state unemployment, then that's $14,000 that you put on to your tax return that you haven't paid taxes on. And so if you didn't earn any money throughout the year, especially due to the pandemic, where your business or your company was closed throughout most of the year, but you drew unemployment, you're gonna have taxes owed, especially if you're a single person with no dependents and no ability to get any tax credits.
Wow. I figured there was um, a little more nuance to it than just, hey, everybody's getting extra $600 a week, and even though it's much needed, I was been meaning to just get with you personally about, like, what does that mean? I haven't. I'm on a different side of the spectrum. I'm mostly dealing with people who are in retirement and doing with investments, things like that. But for younger people or for other people who were affected by that, I just kind of wondered um, how they were proceeding with that, and what all implications that could be. So have you kind of seen a lot of that, or people who didn't have it set up the right way, or people who hadn't been paying taxes on it? Have you
Well,
seen it, a lot of it?
well, like I said, for the state of Arkansas, they haven't made it to where the people that are receiving their unemployment have the ability to take state taxes out. So I don't think it's given an option to them. It's given an option to do it federal wise, but not on the state side. And the unemployment been taxable to the state of Arkansas since 2018.
Wow.
Years
Okay.
before that, it wasn't considered taxable income. So you can receive unemployment compensation, but not have to worry about it being taxed on your state income tax. And then some states don't even have income tax as far as the statewide, so then they don't have to worry about that. But states that do, sometimes they have in their law where they change to where unemployment is a taxable income amount to states where it used to not be. I mean,
Okay.
even when I was studying for my CPA exam, they would say that state unemployment compensation received was not taxable to the state, but it is now.
Okay. Wow. That's pretty powerful. I'm sure a lot of people will be affected by that, and didn't really know the parameters of that. So we're running up on our hour here, man. I just kind of wanted to give you one last thing. I stress to my clients all the time, like, it's important to have your own personal executive board. And what that looks like is having a financial advisor, a CPA, and an attorney. Every person should have those three members on their executive board. And, I've been able to work with you and some other attorneys to be a part of that. But just, I know in my experience how vital having a CPA is. But just if you wanted to just pitch to people how vital it is to have a CPA, and some of the things that you help them with throughout the year to add value and keep them protected. What are some of the most important things you want them to know?
Well, just as you touched on the executive board, I mean, the executive board is set up to be the administrative side of your personal and business life. So from a CPA perspective, you have someone that deals with taxes, someone that can help you deal with the IRS, and someone that helps you deal with your business overall. So if you are in a position where you have trouble trying to manage all these things all at once, then it would definitely be beneficial for you to retain a CPA in terms of from the administrative side, because the best thing that you can do for yourself is to keep running your business as opposed to try to do everything yourself. Really look at the importance of delegation, because delegation is going to save you time, headaches, and a lot of money. Because if you try to keep up with everything all at once, then you'll fail at something else that you're going to eventually neglect.
Yeah, I agree with that 100%. I've, through my personal life and professional life, and then starting business, I've gone through probably all the aspects of taxes, like from doing it myself on TurboTax, from letting somebody else do it who I worked at, Jack H&R Block, And then before getting with an actual CPA to do it, like all three of those look different. And I was thoroughly impressed at how thorough and all the other things that you were able to take care of. And so I've always just kind of been an advocate for working with CPAs. And that distinction is a big difference. You know, it's like I tell people all the time, they're like, you know, I can download Robinhood and I can trade stocks myself. Like, you know, I can do it myself. How could I benefit from you? And it's like, you know, I could technically get on Amazon and order some tools and get myself a root canal, but I don't know what I'm doing. I could save some money and do that, but I mean, you can do whatever you want to do. But I've learned in life that a lot of times you get what you pay for, and there are people like when people are professionals and have been accredited as such, like that means something. And more so, like I know it's something that I don't have to worry about. Like that's what I tell people. Like I'll take the worry out of people's life who have a plan. You know,
Yeah.
I handle things from the financial side that with enough research and due diligence that you could do, but you also have to live your life outside of that. And I guarantee you don't have as much time to dedicate to perfecting this craft as I do because I do it for a living.
At all.
Yeah.
I mean,
So
you know, it's it's funny you touched on that, and I'll be brief with it's like me when me and my fiance we be having conversations, and she's a therapist, but then I be trying to talk about stuff that involves therapy, and she have to remind me like, look, I'm I'm licensed. I'm this and I'm like that. I'm like, you're right, you are. And he's like, you know what? I have to stay in my lane because I don't know it all, and there's no way for me to know it all. And so, just from a personal side, if I was in the seat of someone else and needing a CPA, I'm looking at a CPA from the standpoint that this person has studied, passed the test, got licensed, and did everything necessary to represent himself or herself in a professional manner where they are a representative to protect the public. You know what I'm
right,
saying? So
right,
that's the deal with, as opposed to someone going to just a tax representative or someone just doing taxes on the side or whatever. This person has the license just like a doctor to protect the public. A lawyer has the license and pass the bar to protect the public. So that's the thing, is that we have a higher degree and a higher responsibility, because if we don't do that, then we get fined, we lose everything that we work for in our careers, and that's not something that I'm willing to do, and I know you're not willing to do that either. So that's the thing. We just do things in a more in a perspective from a ground foundation of integrity, and always willing to do the right thing rather than the thing that's going to create a quick dollar.
right. Yeah, yeah, you're absolutely right. We feel the exact same way about that. I remember, and just wrapping up, I was watching the Senate hearings on the AMC on the GameStop kerfluff that happened a couple weeks ago when all those people in the investment company like ran up the price and made all those trades, and it was just so funny. Like because Robinhood's the theme of Robinhood: take from the rich to give to the poor, and empowering the individual, to do for yourself and make your own trades, whatever, which is fine. I'm totally for that. But all the senators kept asking the people that work at the company, they were like, don't you think that there should have been some sort of professional, somebody to help safeguard the people? Like, shouldn't the people have been educated and had somebody advocating for them? And the guy was kind of like, these are all people who said that they didn't want to use a profession. They wanted to do it themselves. So why are we getting the blame for it? Like, did some people hang themselves? Yes. But did they freely give the rope because they wanted to? They didn't want to work with any professionals to do it. They wanted to do it themselves. And then when the hammer got dropped, everybody was like, well, where were all the professionals to help the people? And it's like the people freely chose not to have professionals help them because they were more interested in free trades. So, and it was what it was. But Yeah, we have a different duty, honor, and obligation, like personally and legally, to, like you said, protect the public, and that's kind of what this is kind of based around, man. Just making sure people are empowered and have knowledge and access to professionals and to resources to help them, or just information, access to information to go find it. So, yeah, man, I definitely want to just thank you for taking time out of your schedule today, man. I definitely don't want this to be the last time that we do this. I think every so often we should just have talks with our CPA, just have you on, man, so we can talk to the people, make yourself accessible. So, even though your background has all of your contact information, but is there any additional contact information that you want to give to people, or let them know the best time or best way to reach you?
No, just go to my website, www.thesumofitall.net. You can request a consultation from there. We'll email you with the available time and date if you want to have a consultation, or if you just want general information. Usually when people call me or they just need some help with something quick, it's free of charge, and so I don't mind sharing any information, especially if it's something that's going to help you get to where you need to go really fast. And therefore, because I do it from my heart, and I don't see anything in terms of needing to charge anybody for something that I love to do. I love helping people. I love providing information as much as I can. I may not know everything, but what I do know, I will try to share it, especially if it's going to benefit you, in the long run. So just check out the website. You can call me or email me, whatever you want to use to reach me. I'm reachable.
Cool, man. Okay, so everybody feel free to look out, contact Mike if you need anything on the CPA side. For people watching the playback, definitely make sure to reach out. My information, you can reach me on most of my socials, but my phone, if you need to reach me via a call, is 870-974-5210. You can also reach me at al.moore, MOORE, at regions.com. Or actually, surprisingly, I get a lot of people who reach out to me on LinkedIn. So LinkedIn is good too. You type in Al Moore, Regions Investments. It'll pop up and you can DM me. I check that pretty frequently. So yeah, email, phone number, LinkedIn. You just have a question or anything like that, feel free to reach out to either of us. And with that being said, I'm gonna let you guys have your Saturday back. For all the people who attended live, we appreciate it. For people watching the playback, we appreciate you for tuning in as well. Be sure to like and share this so we can get the message out, and we'll be doing this again. To my friend, brother Michael, I want to thank you for joining me again, man. And we will see you guys next time. Bye-bye.